Get the inside track on the $1 trillion closed-end fund universe on January 14th at 2 p.m. Eastern Time as CEF Advisors holds its quarterly closed-end fund, BDC, and interval fund market outlook. It's everything you want to know about discounts, yields, leverage, activism, pricing trends, and more. Earn 1.5 continuing education credits. Register at cefdata.com/quarterly.
We're looking at 2025 now that it's in the rearview mirror with John Cole Scott, president of CEF Advisors. Welcome to the first Navigator of 2026. This is the Navigator, where we talk about all-weather active investing and plotting a course to financial success with the help of closed-end funds. The Navigator is brought to you by the Active Investment Company Alliance, a unique industry organization representing all facets of the closed-end fund industry, from users and investors to fund sponsors and creators. If you're looking for excellence beyond indexing, the Navigator will point you in the right direction. Joining me again today, John Cole Scott, president of CEF Advisors, where they produce great data covering closed-end funds, business development companies, interval funds, and, as of recently, exchange-traded funds of all stripes too. You can dig into the firm and its data for yourself by going to cefdata.com. Beyond CEF Advisors, John is chairman of the Active Investment Company Alliance, which you can learn about at aicalliance.org. John Cole Scott, Happy New Year. Welcome back to the Navigator.
Happy New Year, Chuck.
Last week, we were looking at your forecast for 2026. This week, it's a look back at what happened in closed-end funds during 2025. And I will point out that while our audience is hearing this after the ball drops to open 2026, we're recording it in the afternoon on December 30th. Less than one full session left of trading for the year, but it means that the numbers you give us here may be a hair off from the final 2025 numbers. But again, if folks want those exact final details, they can find them at cefdata.com. So let's start our look back with your look ahead from this time a year ago, because you made 6 preliminary look ahead forecasts. How did they turn out?
Yes, so the easy ones, I said no recession, and in that case, clearly I was correct. Next, I said that inflation would be sticky, and I was talking about low threes, and we looked at the data as of yesterday, and the best data we see is 2.7. So in this case, I was wrong. Inflation was not as terrible as I expected.
Missed it by that much.
We do love our thinking about interest rates with closed-end funds, both because of the bonds and also the leverage they use. And we thought that the 10-year would have stayed stickier and higher than it did. We were calling for about a 5.25 to 5.5. And right now it did hit that mid-year, but it ended at 4.1. And so we were surprised by lower rates in the year than we were forecasting for our clients. The next three really about the growth of interval funds and the related structures. There's 120 interval funds, we thought, at 120 billion, and there's actually 147 at 146 billion. That sector grew even faster than our, we thought, aggressive forecast.
Yeah, and although we have to therefore say you didn't get it right, you were probably closer than anybody else who was looking at it, because it was way beyond most people's expectations.
It is, and the even less common tender offer funds, there were, we were calling for 130 and 95 billion, and it was 145 at 116 billion. Again, different guts, similar wrapper, and we were under forecast as well. Now, the last one, we were the worst off, the non-listed or private BDC. We were close with the numbers. We thought it would go from 103 to 110. It went to 114. The difference was we were modeling 280 billion and it went to 350 billion. That sector was on fire this year.
So again, we have to sound this one, but you were just a little conservative. I wouldn't call it way off wrong. There is the difference between a buzzer, meaning, yeah, you didn't get it right, and then
it's wrong, shockingly wrong.
Let's move from the preliminary basic forecasts to the sectors and the funds and the economic outcomes you were looking for the year.
Yeah, so we called for a year where the average closed-end fund per our 15-sector index would beat the equal weight S&P 500. We use that because very few closed-end funds have anything to do with the S&P 500. And the average closed-end fund is looking to model the year out at 9.8% versus RSP, the equal weight, is looking to do 10.2%. So we are wrong, though, again, rounding wrong, in my opinion.
Missed it by that much.
Yeah, rounding wrong. Missed it by that much.
We thought that fixed income would be a large contribution this year, and we were pretty much wrong, except for the two sectors that buoyed that area. Convertible bond funds are up around 16% total return this year. International bonds up 12.5%, both above the average closed-end fund on the bond side. We looked at discounts and the average small premium, 50 basis points for the sector index at the end of the year, and basically widened to 2.6% at the end of 2025. And so we did see that the discounts widened about 3%, which we say is correct. All right, and we the January effect, which happens pretty much every January, and we said it would be muted, and this is a little rough, but we said muted is less than historical average. Average is 2.7. We caught 2.5, so we'll give that as a narrow win. However, we think this is more important. We said outsized bumps in both munis and BDCs, which are very different investments. Munis did a 5% pop. BDCs did a 7% pop. We think that was more than expected, but people that traded those got a lot of alpha after the year end.
Winner, winner, chicken dinner.
The next one, we said that the distributions would be stable for many factors. They were actually down 0.3%. I would define that as stable, but I'll let you be the judge here how well I called that.
Oh, I'm willing to give you credit on this one.
We also talked about activism, such a big focus for 24, and we said it would be curved around, but not as deep. And so we thought that would also be one of the reasons why it would keep the dividend stable, because boards weren't willing to do a lot of cuts, which can lead to discounts and give ammunition to these activist investors. And we also said that the largest NAV yield would go to 8.25 versus 8.5. And we were wrong. It only slipped down to 8.4. And so that was basically the mechanics of the returns required at each fund to hit the distribution policy set by the board. So I think that's lightly wrong in my opinion.
We're just going to have to settle for.
But then digging back into activism, like I said, it was much more featured proxy battles, more public campaigns in 24, broader targets across many sponsors. The tone was pretty much confrontational with high visibility, but outcomes were still mixed, relatively few outright board takeovers and more incremental concessions to all shareholders. Versus 25, there were fewer headlines, proxy battles occurred, but the actions did not produce many more concrete results. And so basically more negotiated settlements, and there are some court rulings in progress. They'll probably determine hopefully in 26, set the tone for next year. But we think definitely more muted, but around as we expected.
So that one again falls into the win category.
Correct, boy wonder.
A big part of our practice for clients is tax loss selling for taxable accounts when the bumps and ebbs and flows happen. We called for about 3 periods of time, and I'd say that is correct. We calculated in April, July, and November, we're able to do tax loss selling for almost every large account, and even some accounts. I was doing lot level trades this week to kind of finalize and reduce their tax as much as possible. So we're right, another year of at least 3 times the tax loss trade for our clients. Now I want to dig into some of the sectors we said we thought would do well. Global equity, which we liked, and then was a surprising overwin success this year. By our index there, it's up about 47.5% year to date versus the average US closed-end fund is up 11.2%. And that was a clear win. And then even covered call funds, which is supposed to be less volatile, slightly outperformed US funds up 12% versus their 11%. We thought that was a very good way to show that our equity picks outperform versus base case. Munis, I'm conflicted, about 6.7%, which is a good year if you're an income investor, but not a huge year. But basically the yield was paid out to investors. However, discounts narrowed 4.5% in 25, after narrowing 4.5% in 24, really showing they were so cheap 24 months ago, as we talked in the show. Great way to invest, and I think a good success for outperforming based on what you expected from the guts.
So that one is a mixed bag. I mean, honestly, you could go this way.
Gee, I guess I was wrong.
But I also wouldn't have faulted you if we had gone this way.
Yeah, the closed fund wrapper gave us alpha, but it wasn't a home run versus some funds in the sector. We then dig into the hybrid balance category. It's one we've often liked. There's some interesting, unique funds there, but that basket was up 13.4, which is about 4% over the average closed-end fund. And so we're glad we picked that as an overweight for our clients. Now, converts, we already talked about them doing so well. We thought that they wouldn't do well this year. The only caveat, while they're up about 16%, their discounts widened 5%. That's how well they did, because the interest rate cycle and the tech outcome was different than we forecasted. So that was a wrong on our side. Now, senior loans, I kind of wish we weren't so right here. The discounts widened 4% and total return, they were flat on the year. We had called to be underweight them at the start of the year, and that proved to be correct. And BDCs, I use the word thoughtful, Chuck, and I know I use that word a fair amount because we invest thoughtfully, not just sporadically, but the top third of BDCs were up 7.3% through end of the year. The middle third were off 5 and mid-change, and the bottom third off more than 20. That is more than 10% between these thirds and really reminds us why we dislike the passive indices. And we suggest both actively selecting good funds at good prices and not being tethered to a 12-month window for any BDC.
Last thing that we need to get to, you picked 5 funds for the year ahead. How'd they turn out?
Yeah, so the equity fund we picked was EOD, and it did, almost 30% total return this year versus index was around 23. That is 6 and high change alpha. We consider that a win. The taxable bond fund was a multi-sector fund, SABA. It actually was just above flat total return this year, about 7.5% wider than its peer group average. Its discount actually widened 5.5% more than the average fund in its universe. And so that proved to be a bad investment versus peers in 2025. Now, the muni fund was NMCO. It did just under 5% total return for 25. The peer group was about 6. And so it's a 1 in low change fall, which we count as a miss because that's a significant piece of a muni performance.
Yeah, close, but no cigar.
Now, we picked TBLD for that hybrid balance sector that we love. It was up over 31% in 25. The peer group was under less than 13. That is an 18 and change alpha. We were grateful to own that for clients last year, made tons of extra money in our opinion.
Now we're talking business. Let's talk business.
Yep, talking business, making money for your clients.
Now, the last one is the BDC, and I'll tell you, like every year, I'm usually down to 2, and I wish I could change last year's pick, but we picked GSBD down 8%, which is still closer to the middle third than the worst third, but the peer group average was off 3.7. That's a 4.5% delta. They did do a large dividend cut in the first quarter, which other funds haven't done yet, and we think they were beat up more for that. We still like it, but we did not pick the best BDC last year, but clearly not the worst. But to finalize it, you put them as a portfolio, which they're not, but a 5 sample portfolio. They average 11.6. The index averaged 9.8. Their peer group averaged 9.2, which means even though we didn't do perfect, we did do over 2% alpha versus the base case peer groups. Have we just liked the peer groups that we selected? And we think that's a great way to end the call.
Yeah, because it allows us to say that in spite of the fact that there were some buzzers in there,
I'm never wrong.
Well, I know you would never say you're never wrong, but it's never wrong for us to talk closed-end funds with you, John. Great stuff as always. I look forward to chatting with you again as we move into 2026.
Can't wait for it, Chuck.
John Colescott is president of CEF Advisors, and he's the chairman of the Active Investment Company Alliance. His firm is online, and you can dig into their data at cefdata.com.